Markets enter correction territory, but they're very oversold. Are they due for a rally? That's up on today's 3 Minutes on Markets and Money. Yesterday, because of Russia headlines, markets dipped into correction territory. Now, that's a decline of 10% from the previous peak. And certainly the market has been under a very good amount of pressure here ever since the beginning of this year due to a variety of concerns, from slowing earnings growth now to the Federal Reserve, higher inflation, they're going to have to hike rates, and then, of course, the Russia-Ukraine event has now put additional pressure on stocks. It's been a very challenging year so far for the bullish bias of the markets. But yesterday, markets did actually hold support at those January lows, and also those are the October lows. So again, right now, the markets are holding very critical support levels and should actually get a rally here because of very negative bullish sentiment across the board, no matter where you look, whether it's the American Association of Individual Investors, professional investors. Sentiment is very negative across the board, with markets now retesting support, very oversold on multiple levels. And also just because we've had this very extended 2-month stretch of just pure selling in the markets, markets are now to the point that we should get a fairly decent reflexive rally, at least back to this previous downtrend. Now, markets are set to open up this morning. It'll be important if markets can hold on to that gain today, and that should be able to allow markets at least to string together a couple of days of gains here. That rally up to this potential downtrend line should be used to continue to reduce risk in portfolios, rebalance positions, look to add hedges if needed. We're not out of the woods here just yet from a risk perspective. Not only do we have the risk between what is happening in Russia, but also in the next 4 weeks, we'll have the Fed meeting. And of course, whether or not they're going to hike interest rates by a quarter point, half a point, or really, are they going to be able to hike at all is really the question here. With this decline in the markets, geopolitical risk, and inflation likely to start to peak here, we may see the Fed have to back off their rate hikes. Now, that would be bullish for the markets and could extend that rally into March. Now, after 2 months of very negative bias to the markets, it wouldn't be surprising to see a month or two of a more positive market structure. So again, use that type of rally here to rebalance those risks. And this is the problem for most investors, which allow the negative headlines to begin to affect their investment decisions. Making decisions when markets are extremely oversold to get out of the markets, become more negative in portfolio positions, tends to occur right before you get a decent rally in the market. Try to use rallies to reduce risk and rebalance activity in your portfolio. That way, as the markets begin to adjust, you kind of adjust with it. So use a rally opportunity to rebalance the risk rather than panic selling at market lows. Now, importantly, if we do break these lows of January, that's a different story. We'll certainly cover that if that occurs. But for right now, we should expect to see at least a short-term rally here over the next day or two. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll be back tomorrow.